If you're maintaining stocks in companies like Nvidia, Apple, bonds, or perhaps even a savings account, or genuinely just any investment right now, what you're about to discover could either protect your prosperity or leave you potentially devastated. Right now, something very strange is occurring. The stock market just hit all-time highs while unemployment is climbing up. Here's the chart on the screen. It's only a little movement, but it's a substantial movement by historic standards. And this is backwards. It's like your car running superior when you're out of gas. It doesn't make sense whatsoever. And what's genuinely occurring could determine whether your investments survive what's coming next or not. My name is Felix Pin. I'm a former investment banker. This is Winston Back. They're the brains behind it all. And we've spent years studying how Wall Street actually operates. We've perceived the system from the inside. I'm also the founder of the Goat Academy, where we've taught about 20,000 regular people, which is what I utilize to be, apparently. Now I'm a little irregular, and I teach them how to protect their prosperity from the schemes and shenanigans of the levies on Wall Street. I'm also the co-founder of TradeVisioner.io, where we provide market news and data at the quality level if you're laboring in banking. And for this video, Winston has analyzed Fed data, institutional patterns, historical market crashes, and discussed with my research team of several cats, and come up with something that I reason is genuinely worth comprehending. So we're going to fracture down 3 critical things. First, why the stock market appears robust when the economy is deteriorating. Second, the 3 forces artificially propping everything up right now. Third, the specific steps you can accept this week to position yourself before this house of cards shifts. So by the termination of this video, you'll comprehend precisely how to protect and expand your prosperity no matter what occurs next. Of course, I'm not a financial advisor. I'm not registered for anything whatsoever. Winston might be, but I'm not. So perceive this as the basis of your research, the beginning of it, not the termination to all your questions. So let's dive in. Let me position this into perspective with some difficult numbers. In April 2025, I understand it seems like a long time ago, but the market crashed like 5% on one day, April 3rd, and then another 5% on April 4th. $6.6 trillion of prosperity disappeared in 2 days. So if you'd invested $10,000, you would have lost $1,000 in 48 hours, which is genuine currency. Now, the weird aspect, within weeks, all that currency came back. By June, the market was higher than before the crash. Now we're sitting at basically all-time highs. While unemployment is the highest in 4 years, the Fed has cut interest rates 3 times in a row. And obtain this, the US government is spending $2 trillion more per year than it accepts in, which is merely bananas. But here's what makes it worse. Companies like Nvidia are worth like $5 trillion now, more than most countries. And just 7 companies, 7 out of the S&P 500 companies, are responsible for almost all market gains over the last 12 months. And these deficit numbers seem abstract. Like, what does it matter? It's a trillion more or less. What is that between friends? Well, it's as if you were the average American household, it's like spending $266,000 more per year than you earn. Imagine positioning that on your credit card year after year. How long do you reason you could maintain going before, well, the house would collapse apart? But this isn't the first time we've perceived this pattern. And that's why I'm a huge believer in studying patterns and where the currency flows, because that leaves great substantial giant elephant footprints, even larger than Winston's. So let me accept you back a little. In the 1970s, we possessed something called stagflation. That's when 2 poor things occur simultaneously to nice people. Prices elevate and jobs decline. It's like obtaining sick and then fracturing your leg simultaneously. Double trouble. Back then, the stock market collapsed 50%. So if you possessed $10,000 invested, you lost $5,000, and it required a very, very long time to recover. Are we in stagflation right now? No, not yet. But we're perceiving early warning signals. Inflation appears elevated. Unemployment is rising. Identical pattern we perceived in the early 1970s. In 2000, we possessed the dot-com bubble. Everybody was excited about the internet, right? The latest thing. And stock prices went up on the basis of how much these companies spent, which is a little bit like what's occurring with AI right now. But people then stated, this time is different. And then, well, it busted, right? I was investing back then. That's when I just initiated. I initiated in 1999. Not the greatest timing, but perhaps it was because it was a very early lesson which assisted. In 2008, they call it the housing bubble. I call it the credit rating agency fraud compensated for by investment banks. But then I possess a substantial imagination, and of course that wasn't the case, because credit rating agencies are honorable people who care about nothing but the prosperity of the country and not their personal, you understand, brown envelope jobs. Those never occurred, clearly. But what occurred then is that banks were accepting hidden risks that regular people didn't perceive, right? And if you go a little bit further into where we are right now, well, Silicon Valley Bank, a top 10 US bank, collapsed in 2023. That shocked everybody. I remember I was in Mar, which is a genuinely horrid location in the south of France that utilized to be nice once and has now been overrun by, you're not permitted to state that anymore, are you? But they possess an issue that is pretty significant. Now, every time we've perceived markets elevate while fundamentals deteriorate, history demonstrates us the identical pattern. Eventually, reality catches up with us. So the question isn't if, but when. So what's the solution? Well, most people reason we can merely solve this with traditional approaches. Let me inform you that each one of those doesn't function. And why? You could print more currency. Yes, you can. That leads to hyperinflation. They're going to print more currency, quite a few trillion more. They maintain executing that. They enjoy it. Maybe you don't believe me. Just type M2 and Fred into Google. I don't understand who Fred is, but he seems to be the guy. He's obtained all the data. It's the Fed's data depository. And this is how much currency there is in dollars, right? So if you reason this won't cause inflation, well, you should apply for the Fed chair. Although the role I reason merely obtained filled because you're a lunatic. So when you go from, say, 2020, we possessed 15 trillion and now we possess $22 trillion. What occurs when you add $7 trillion to 15 trillion? You've almost increased the amount of currency by 50%. And what do you reason occurs to the value of the dollar? There's 50% more of them, therefore it's worth 50% less. That's straightforward mathematics, right? And they're going to continue to execute that. But they can't execute it to the extent they'd appreciate to, because then it would cause hyperinflation, and then we become Zimbabwe. And we all understand how that transformed out. You could cut spending, which means you lose your job if you're a politician by next Tuesday. So it's never going to occur. Because would you vote for the guy who cuts spending? In all honesty, you don't, right? The Social Security recipients would vote with their feet, and you'd be out the door faster than you can state. You understand Botswana? I don't understand why I reasoned of Botswana. You could default on the debt. Yeah, it would destroy the dollar's reserve currency status. It would be the termination of the global financial system. No country would trust the US ever again. Could you elevate taxes? No, you can't, because again, you obtained voted out of office, and it wouldn't fix the problem. If you accepted all the currency from every US billionaire at 100%, it wouldn't make much of a dent. What else could you execute? Well, you could expand the economy, right? That's what Papa Trump states. Well, you'd need 8 to 10% GDP expansion for decades. That never ever occurs in modern history. The US executed a little bit of that after World War II, but it isn't something that continues for a long period of time. So the reality is, there is no traditional way out of this, but there is something occurring behind the scenes. And here is what Wall Street comprehends that most retail investors don't. There is only one path that makes financial sense right now, and it has already occurred. The Fed is artificially propping up the market, not because the economy is healthy, but because it's sickly. Consider it this way. The Fed is like a nice parent. When things initiate to appear poor, they step in to assist. They're cutting interest rates 3 times in a row. But here's the key. They're providing the economy medicine because it's sick, not because it's healthy. When you lower interest rates, borrowing becomes cheaper. Companies can invest more cheaply. Consumers obtain cheaper loans. Historically, this makes markets elevate, but it's treating the symptom. It's not treating the disease, which is a lesson I reason the Fed acquired from pharmaceutical companies. Yes, hello, my pharma friends. We love you. We understand you possess the interest of humanity at heart. Now, the second thing institutions understand is that there are only 7 stocks out there that are holding up the entire market. Imagine you've obtained a backpack, and you've obtained 500 books in it, but only 7 of those books are actually heavy. Those 7 heavy books are making the whole backpack experience heavy, and that's the market right now. If those 7 companies stumble, the whole market could collapse with them. That was probably a terrible analogy, wasn't it? I couldn't genuinely reason of a superior one. Winston, can you reason of a superior one? No. All right, let's shift on. Position 1 in the chat down below if you can reason of something superior. It'd be a favorable thing to utilize. Now, here's what separates Wall Street from retail investors. They comprehend not merely the 3 pillars I'm going to walk you through, but they comprehend the systematic, pattern-based approach that's been around for 50 years, that institutional investors have been utilizing for over 50 years. Why haven't they instructed this to you at school? Well, they compensate quite a substantial amount of currency to politicians to make sure you remain uninformed, so that you have to hand over your currency to them so they can charge you fees. It's my conspiracy theory. There's almost no basis of that in reality. Well, you judge for yourself. But I desire to execute something superior for you than merely provide you this video. 1. I'm going to provide you a workbook with all the information and data that we're walking you through here. That's in our free community at felixfins.org/resource. You can download that. There's a link to that down below. And secondly, For those of you who are a little bit more serious-minded, who actually desire to acquire the abilities to make superior determinations, I've recorded a 17-minute video for you which walks you through the institutional principles for discovering the correct industry and the correct stock, and then making superior determinations all around as an investor. And you can observe that also for free at felixfens.org/getfree. Now, I type of reasoned that link would be favorable because it would state you can obtain free as an investor, but that's apparently not permitted to be stated by you understand, the almighty rulers who rule the YouTube world. So it's now called Get Free because it's a free video. You perceive what I executed there? Yes. Okay. All right. So let us fracture down the principles one by one. We've obtained Fed rate cuts, more incoming from the new Fed chair. It's medicine for a sick economy. We possess an insanely concentrated market with only a couple of stocks holding up the whole thing. You perceived what merely occurred when Microsoft coughed. They coughed out a little bit of Sam Altman, apparently the whole ChatGPT OpenAI. It merely smells evil, doesn't it? I'm not stating it is. I'm sure Sam Altman is a stand-up guy and all that, but it merely comes across as genuinely evil. I don't understand why. And then we've obtained insane government spending. So how does this function? Well, the Fed cuts interest rates. That means banks obtain cheaper currency, and that means they lend more easily. So companies, therefore, obtain more currency. They're going to purchase back their own stocks. And consumers spend more because consumer credit obtained cheaper. So you compensate less for your car loans and your credit card loans and all the stuff you possess on hire. Do people still execute that higher purchase? Or is this like an 80s concept? Let me understand if you're American in the comments down below. And all of this flows into the stock market as an artificial boost. And on top of that, you also possess government spending. The government spends $2 trillion more. What's it spent on? Well, services and companies and constructing things and weapons and more weapons, probably. So all those dollars flow into companies who then compensate other companies to compensate other companies. So it terminates up in the stock market. So we possess artificial support, the Fed spending, general AI exaggeration. And so the markets elevate while the economy appears a little bit shaky, but there are warning signals. People are disregarding it, but you're smarter than that. So you're initiating to comprehend what's occurring here. First of all, inflation is a hidden tax, right? So if inflation were merely 2.9%, official government number, then you'd be losing 2.9% of your currency every year, right? Now, in reality, I reason inflation is much higher than that because there are things that have elevated substantially more than 2.9% last year. So if we examine QQQ, the NASDAQ, how much has that elevated by over the last year? About 89%. Can that be correct? That's insane, isn't it? No, this is gold. Not a tech stock. It appears like a mean tech stock, doesn't it? Well, there's a favorable example. The people possessing substantial amounts of gold, who are the wealthy institutions, the Fed, central banks, they're 800% wealthier than you. And that, I'll inform you, will make other things more expensive because these guys are now wealthier. That is inflation. Asset prices elevating. That's genuine inflation. It's not the price of milk or eggs or any of the nonsense they desire you to believe. But even if you believed in this 2.9% myth of inflation, over 10 years, your $100,000 loses $25,000 in value. Whereas if you invested in assets, you'd possess $47,000 more. So altogether, you're still losing, what is that, $72,000 compared to the guy who was in the correct thing. That is the prosperity transfer. Stock owners, if you're in the correct stocks, not all stocks, because examine the S&P 500. There are 7 winners and 493 losers, as your president appreciates to state. Real estate, if it's the correct type of real estate. Commodities, gold, silver is executed insanely well. I reason it will likely continue to. If you've obtained savings accounts, fixed bonds, cash, those duff stocks, then I reason you're in trouble. So what's our solution here? No one desires to position all eggs in one basket. It never sounds particularly sexy. Everybody always desires to be in the latest thing. But the AI thing, I reason it's going to be great. It's going to be amazing. But it's going to require way longer than you reason. And we're going to possess a period where the market is disappointed with AI, and then it's going to elevate back up again. So you're going to examine, are you retiring next year or in 30 years, right? That'll impact how you determine what to execute with it. So I would possess AI exposure. I execute. I possess tech stocks, absolutely. But I also diversify into other things, certain financials, metal stocks, biotech, solar. All those stock sectors are executing very well right now. Now, will those sectors still be the ones I'm maintaining in a month or in 3 months, whenever you're observing this? No, not necessarily. So acquire yourself the principles, so you understand superior where to position your currency. And you can execute that at felixfens.org/getfree. But the objective is always, if the latest thing pops, you possess other holdings that'll actually elevate when those decline. That's what we execute. So corporate bonds can be a favorable location to be. Some of them compensate 7% with relatively reasonable risk. Again, I'm not a financial advisor. You've obtained to come to your own conclusions. Short duration bonds can be a favorable thing for those emergency funds and so on. Long maturity bonds, generally a terrible location to be, because inflation could destroy them. So what do you desire to possess? Look, we've obtained to possess some currency in an emergency fund, right? Position that into a high yield savings account. It's type of dead currency, but it's there if you ever need it. Now, could you position that into gold? Yes. But if you genuinely desire to access it, you're probably going to compensate a premium to liquidate it quickly. We desire to possess some genuine assets, gold, silver, real estate, if it's within your price bracket. And those are an inflation hedge. Those protect you if the dollar maintains losing value, which I believe it will, new Fed chair or not. And merely avoid this. What I perceive so frequently, I've perceived thousands of people's portfolios, and it's always like they're 100% in the latest thing. I'm like, you're accepting so much risk. Or they possess 98 stocks, but they're all in the identical sector. I'm like, just purchase one, or purchase the sector, or purchase three, and don't make your existence so complicated, right? But the worst thing to execute, in my humble opinion, is to await the crash. Because given what the government's executing and how much currency it's spending, I don't reason there will be a crash. And that's my humble opinion, which Winston's willing to back up. Aren't you, Winston? Not much support, is it? No, reasoned I could count on him. Oh, never mind. And let me provide you one more bonus principle, particularly if you observe the mini masterclasses. It'll assist you. If your position is up substantially, right, establish a stop loss somewhere. Could be break even, could be 10 or 15% below or 6% below. Depends on what you maintain. You could acquire about ATRs. There's substantial stuff to that. There are layers to that knowledge. But the key is to never permit a winner to become a loser, right? I possess losing stocks. For example, I purchased United Health. It elevated, I don't understand what, 15%, and then it declined again, and I exited with a small loss. Why? Because I had established a stop. I didn't have to reason about it. When it collapsed, when it crashed, a principal obtained, triggered, and it's out of the portfolio. And now there's a nice bit of cash that I can then reinvest. So we don't ever desire to permit something to become an anchor, right? Tied around your ankles as you're swimming in a sea filled with sharks, which is pretty much what Wall Street is. Now, the new Fed chair is going to be an interesting one. If the Fed becomes genuinely supportive and initiates cutting rates frantically, I reason we should be more in stocks and gold and silver. If the Fed becomes more hawkish, I would decrease my stock exposure, certainly the higher risk aspects of the stock exposure. So you always desire to trade with the wind. And I'll judge that simply by where the currency is flowing. And by that, I mean the institutional currency. And again, the free masterclass, you desire to go a little bit further into that. So some exit principles here. And these are not financial advice. They're not firm. They depend on where you are in the risk world. Age and income streams and portfolio size and those values and so on. But never permitting a winner to become a loser. Adjusting for market circumstances. Executing some rebalancing. Cutting losses somewhere. Maybe not those numbers, but somewhere. That's something that's a very favorable thing to execute. And then you're going to question me, well, when will the market collapse? Surely it will because of whatever you believe. And examine, we can't predict the collapse. But we can perceive very clearly when the warning bells initiate ringing. And there are a couple of things to that. VIX, term structure, and a few other things that almost nobody comprehends. And it's something that requires a little bit more than 30 minutes or whatever you possess in this video to instruct. But we need to be aware that we're at a point where we possess stretched valuations. We're at type of the hoopla of AI. I'm still going to participate in this bull run because I appreciate currency, and I appreciate my currency to perform for me, so it examines after me and my family. But I'm also wary, and I always possess automated risk management in position, because that way, even if something occurs that I didn't perceive coming, I'm protected. So order your portfolio. Identify the risk and the concentration risk you possess. We've obtained a tool for that actually in the community that we possess. You don't have to join that, but if you wish, there's a tool in there called Retire, which informs you all about that and makes some intelligent diversification movements here. And the bottom line is simple. The warning signals are there. You've obtained a government. If the government wasn't spending all this currency, if interest rates weren't being artificially suppressed, we'd possess a massive recession. But the powers that be don't desire a recession. They're enjoying the bonanza, so enjoy it too. You don't need to complain about it. We don't need to scream it's manipulated. Well, you can. It doesn't execute anything. Just participate in it in an intelligent way that protects your currency, protects your risk. But the trouble is, most people are flying blind. They possess no roadmap. They possess no target. They possess no exit principles. They possess no automation established. And that's genuinely what I desire to assist you fix. So observe the free mini masterclass at felixfens.org/getfree. And position in the chat what you discover most confusing. Position in the chat your questions, and I'll read those. I read all comments. And then perhaps we can execute a follow-up video to this where we go deeper into the steps that we actually need to accept. You can also jump to one of my other videos because we've walked through quite a substantial amount of this. How to protect ourselves this year and any other year by following the identical patterns, the identical principles that have been out there for 50 years plus, that my Wall Street mentors instructed. So if you obtained some value out of this, share it with a friend. Share it with a golden retriever, protect yourself, but enjoy the party. Just make sure you're not the last man standing. I wish you all the finest. If you maintain a 401k, a savings account, bonds, or cash, shares, ETFs, what I'm about to disclose to you could mean the distinction between preserving that prosperity through the most substantial monetary shift in